You're looking to get informed and fast. Right. Cut through the noise, understand what really matters.
That's the goal.
Well, welcome to the deep dive. Today, we're plunging into a concept that might just be a game changer for U.S. finances and maybe even how you save.
We're talking about Bitcoin-Enhanced Treasury Bonds. Some call them Euro bonds or maybe BitBonds.
Right. And our mission today, to really unpack this whole idea, what's the potential impact on, the huge U.S. debt, and what could it mean for American families and their savings?
And we've looked at quite a few sources to get a handle on this. There's a policy brief from the Bitcoin Policy Institute, some good discussions on YouTube from Swan Bitcoin and Coin Bureau, articles in places like Forbes and Rich Dad, even a legal take from Law of the Ledger, and a proposal from Vanek, too. So a real mix.
And the backdrop here, the reason we're even talking about this is pretty stark, isn't it?
It is. The U.S. is facing, well, a lot of debt coming due very soon.
We're talking about $9 trillion maturing in the next year.
Roughly, yeah. And over $14 trillion within just 3 years.
And the cost to service that debt, with interest rates around, 4.5% as of March 2025? That's a huge bill.
Exactly. A major, major expense looming. That's the problem these Euro bonds are trying to address.
Okay, so digging deeper. Where did this specific idea, these Euro bonds, actually come from? What's the origin story?
Well, it seems to have really gathered steam after President Trump's executive order on March 6th, 2025.
Ah, right. The one setting up the strategic Bitcoin reserve.
That's the one. It was pretty significant. It basically recognized Bitcoin as a strategic reserve asset called sort of digital gold.
And crucially, didn't it tell Treasury and Commerce to figure out how to buy Bitcoin without blowing up the budget?
Precisely. Find budget-neutral ways to acquire it. And these Bitcoin-Enhanced Treasury Bonds, they're being put forward as, a direct answer to that directive.
Okay, so that's the why. Now let's get into the how. How would these things actually work, the nuts and bolts?
The basic structure is meant to feel familiar, like traditional Treasury bonds. But there's that key twist, the Bitcoin component. So imagine the government issues, say, a $100 bond. Under this proposal, maybe $90 of that goes to the usual stuff, funding government operations.
That's normal.
Like normal. But the other $10, that gets used right away to buy Bitcoin for that strategic Bitcoin reserve we mentioned.
Interesting. So a slice of every bond goes straight into Bitcoin. If we scale that up, what kind of Bitcoin buying are we talking about, potentially?
Well, let's run a quick example. Say the U.S. decided to issue $2 trillion worth of these Euro bonds.
Which is about, 20% of the refinancing needed in 2025?
Roughly, yes. So that 10% allocation we talked about, that would mean $200 billion going into Bitcoin.
$200 billion.
Yeah. And just for illustration, if Bitcoin's price was, let's say, $90,000 per coin, that translates to acquiring something like 2.2 million Bitcoin for the reserve.
Wow. That's a lot of Bitcoin.
Yeah.
It really blends old school government finance with this new digital asset world.
It certainly does. It's a potentially significant move.
Okay, so for the person buying the bond, the investor, what's in it for them? Why buy this instead of a regular treasury? What's the return look like?
That's absolutely critical, right, for people to actually buy these. The idea is a kind of dual return, 2 parts.
Okay.
First, like any bond, there's a fixed coupon payment, interest. But here's the catch. The proposal suggests setting this rate below the rate on conventional treasuries.
Below. How much below?
The figures floated are around, say, 1% annually. Compare that to the market rate for a 10-year treasury, which was about 4.5% back in March 2025.
1% versus 4.5%. That's quite a difference. So what makes up for that lower interest payment?
That's the second part of the return, the Bitcoin link. When the bond matures, the investor gets a payout tied to how well that Bitcoin performed the Bitcoin bought with their initial investment share.
So you get exposure to Bitcoin's potential upside.
Exactly. And there's even a proposed tiered structure. The idea is investors get the full benefit of Bitcoin's price increase up to a certain combined return level, maybe that 4.5% total annual return.
Okay, so you could potentially match or beat the standard treasury return if Bitcoin does reasonably well.
Potentially, yes. And if Bitcoin really takes off, goes way beyond that threshold,
Then what?
then the extra gains, the really big ones, would be split, maybe 50-50 between the investor and the treasury.
Interesting. So the investor gets the initial upside, but the government shares in the home run scenario. That could be attractive. Now, flip side, why does the government do this? What's the big win for them?
The most direct, immediate benefit is saving money on interest payments. Big time.
How big?
If they issue that $2 trillion in Europe bonds at 1% instead of the, say, 4.5% for regular treasuries, that's a saving of about $70 billion every single year.
70 billion a year.
Yeah. Over the 10-year life of the bond, that adds up. Nominally, it's $700 billion.
Wow.
Of course, you have to consider the time value of money, what that's worth today. The present value calculation puts it around $554.4 billion in savings.
Those are huge numbers.
Yeah.
But wait, they spent $200 billion buying the Bitcoin in the first place, right, in that example?
Correct. Good point. You have to factor that in. But even after accounting for that initial $200 billion Bitcoin purchase, the analysis suggests there are still net savings for taxpayers. About $354.4 billion in present value terms. And that's if Bitcoin's price literally goes nowhere for 10 years, just stays flat.
Okay, so even in a flat Bitcoin scenario, taxpayers save money.
That's the baseline argument, yeah.
Look, the whole point is that Bitcoin probably won't stay flat, right? What if it goes up, like many expect?
Exactly. That's where the second major potential benefit for the government comes in. That strategic Bitcoin reserve could grow a lot.
Oh.
Through two ways, really. One, ongoing issuance of more euro bonds over time.
Right.
Two, the government's share of that appreciation. We talked about that 50% split on the really big gains.
Right. And the plan is for the government to just hold this Bitcoin, not sell it.
That's what the policy brief explicitly states. Hold, not sell. Treat it as a long-term reserve asset.
Okay. So what kind of growth are we potentially talking about for this reserve? Do they have projections?
They do. They looked at historical Bitcoin performance, the compound annual growth rates, or SAGRs over 10-year periods. Just illustrative, mind you.
Understood. Give us a sense of the range.
Okay, so based on historical data, at the lower end, the 10th percentile CAGR, which is about 30% growth per year, the government's potential upside after 10 years could be around $0.83 trillion.
Just under $1 trillion.
Okay. Move up to the 25th percentile, a 37 percentile CAGR, and that potential upside jumps to nearly $1.8 trillion. $1.776 trillion to be exact.
Getting serious now. What about the middle ground? Median historical performance.
The 50th percentile, the median CAGR, historically has been around 53%, if that happened. The potential government upside balloons to about $6.5 trillion. $6.48 trillion.
$6.5 trillion from that initial $200 billion investment share.
Based on those historical median growth rates, yes. The power of compounding on a volatile asset. They even showed the 75th and 90th percentiles, which are, astronomically higher, just to illustrate the sheer range of possibilities.
This really reframes it. It's not just about saving a bit on interest. It's potentially about building a massive national asset.
That's absolutely the core idea. It's a strategic play. The brief even throws out a longer-term projection.
Oh, yeah.
It suggests that if Bitcoin achieves a KGR of around 36.6%, the Treasury's upside from these bonds could potentially offset, get this, $50.8 trillion of federal debt by 2045.
$50 trillion. That's aiming high. A long-term debt reduction strategy based on asset appreciation.
It's definitely thinking big picture, long-term.
Okay, let's bring it back down from the macro government level. You mentioned benefits for American families. How would these Euro bonds help regular people with their savings?
Right. This is a key selling point. The idea is that these Eurobonds could be set up as a tax-advantaged savings vehicle.
Like Series E bonds or I bonds, something like that.
Potentially something similar, yeah. The proposal suggests structuring them so the income and maybe even the capital gains could be tax-free.
Tax-free income and tax-free gains, possibly including the Bitcoin part.
That's the potential being discussed. Imagine using that for long-term goals. Retirement, college savings. It could be very appealing.
Tax-free growth with Bitcoin exposure.
Yeah.
Yep. I can see that being popular.
Definitely. And another important aspect is making them accessible, not just for big institutions, but for everyday retail investors, too.
So sort of democratizing access to Bitcoin's potential growth.
Kind of, yeah. But within a structure that also provides principal protection, which is a big deal for many savers.
Right. You get your initial investment back plus the fixed interest, no matter what Bitcoin does.
Exactly. So you get that potential Bitcoin upside, maybe tax-free, without the direct risk of losing your principal if Bitcoin's price crashes, and without the hassle of, managing private keys yourself.
That principal protection is huge. But Bitcoin is volatile.
Mm-hmm.
How do they plan to manage the risks involved beyond just protecting the principal for the bondholder?
Well, the principal protection is the main risk mitigation for the investor, as we said. Guaranteed principal plus interest back at maturity. For the government side and the market, the proposal suggests starting slow. A pilot program first.
Sensible. How small?
Maybe in the $5 billion to $10 billion range for the initial issuance, just to test the waters, work out the operational kinks, see how the market reacts, minimize disruption.
A cautious step-by-step approach. What about the risk of actually buying all that Bitcoin? You mentioned $200 billion in the example. Buying that much could push the price up itself, couldn't it? Execution risk.
Absolutely a valid concern. The proposal addresses this. They talk about strategies to minimize market impact.
Like what?
Things like dollar cost averaging, not buying it all at once, but spreading purchases out over time.
Oh.
Using multiple channels exchanges, over-the-counter OTC desks, bringing in specialized trading expertise, and importantly, keeping the government's buying activity confidential so traders can't front-run the purchases.
Makes sense. Mitigate that market execution risk. And what about securing the Gitcoin once it's bought? We're talking potentially trillions of dollars worth eventually. That's a massive target.
Security is paramount. Absolutely critical. The focus is on state-of-the-art, robust security protocols.
Such as?
Multi-signature custody is key. Think of it like needing multiple keys held by different parties to authorize any transaction. No single point of failure.
Right, like a bank vault needing 2 keys.
Sort of, yeah. And definitely using cold storage, keeping the vast majority of the Bitcoin completely offline, disconnected from the internet to protect against hacking and cyber threats. Plus, regular independent security audits, and having a dedicated specialized team focused solely on securing the reserve. It would need top-tier security.
No question. This is really a forward-thinking, almost radical idea in some ways.
Yeah.
What about the bigger picture? The strategic implications globally?
Proponents argue it could really cement America's position, not just as a financial leader, but as well, the term used is Bitcoin superpower, leading the way in financial innovation that incorporates digital assets.
A Bitcoin superpower.
It could also widen the appeal of U.S. debt. You might attract new types of investors, institutions, maybe foreign investors who want Bitcoin exposure but prefer it within a regulated traditional bond structure.
Interesting. Broaden the buyer base for treasuries.
Potentially. And there's even a national security angle.
How so?
Having a large reserve of a decentralized asset like Bitcoin could, theoretically, offer some resilience against traditional financial sanctions or disruptions in the legacy financial system. It's an alternative rail, so to speak.
A hedge against certain geopolitical or financial risks. Okay. Now, are other people talking about similar things? Or are there any real-world examples, even small ones?
Yeah, it's not happening in a complete vacuum. Brian Estes from Off the Chain Capital floated a BitBond idea a while back, slightly different, maybe a zero-coupon bond with just a small Bitcoin piece.
Okay.
And then there's El Salvador's much-discussed Volcano bond. That's explicitly a Bitcoin-linked bond meant to fund projects. Though as of early 2025, I believe its actual launch was still pending.
Right, the Volcano bond. Heard about that. Any other related concepts?
Well, there's the separate but related idea of just putting traditional bonds on a blockchain. Digitizing the bond itself. That's also evolving. But these heroes, bonds are different. They're linked to the asset, Bitcoin, not just using the technology, blockchain.
Got it. Different concepts. And what's the vibe within the crypto community itself about governments getting involved like this? Is it seen as a good thing?
It's definitely a mixed bag. You'd expect that, right?
Sure.
On one hand, some see it as hugely validating. Major adoption. Bitcoin integrating into the mainstream financial system, potentially bringing in huge capital flows. That's seen as positive by many. But on the other hand, you have people who are very focused on Bitcoin's original ethos. Decentralization, separation from state control, being an alternative to government finance. For them, government-issued Bitcoin bonds. Well, it can feel like a contradiction or even co-option.
So tension between adoption and the original ideals.
Yeah.
Understandable. Okay, bringing this all together then. We've covered a lot of ground. What's the main takeaway from this deep dive into Euros bonds?
I think the central point is that these Bitcoin-Enhanced Treasury Bonds, they represent a really novel, potentially powerful idea for tackling some very real, very large fiscal challenges the U.S. is facing.
Lowering borrowing costs, potentially reducing the national debt.
Exactly, while also building a strategic reserve of an asset with, historically at least, significant growth potential, and at the same time possibly creating a new attractive savings tool for American families, maybe even tax-advantaged.
It really is a fascinating blend, isn't it? Traditional government finance meets this new world of digital assets.
It absolutely is. And maybe the final thought to leave with you, the listener, is this. What does it really mean if a major government like the U.S. starts seriously embracing a decentralized asset like Bitcoin in this kind of structured, innovative way? What could that signal for the future? For national finance, yes, but also for how individuals might build wealth in the decades to come. It's definitely something we're thinking about as this idea continues to be debated and potentially developed.